Cast is now starting. All attendees are in listen-only mode.
Good evening, everyone, and welcome to the June edition of Digging into the BI. This is where members from the DC, Maryland, and Virginia area get together and talk about the latest issue of Better Investing magazine. And here are the four stocks we're going to be looking at tonight. It's going to be e.l.f., it's going to be Paychex, Pfizer, and Semler Scientific. So let's go to our next slide. And thank you for being here tonight, everyone. Here's our standard disclaimer. We're doing these presentations for educational purposes. We believe, as Better Investing does, that you should conduct your own review and analysis of any companies. We will talk about stocks we may or may not own in our personal portfolios or even in our club portfolios. Whatever we are showing here in terms of products or locations is neither an endorsement of those websites or products or services by us or by Better Investing. And as you can see with that blue underline at the bottom, this session is being recorded for future use, and we will get it up on YouTube hopefully later on today or tomorrow. Next slide, please. So who is Better Investing? Again, most of you are members of Better Investing, but we do this so that people who are not members of Better Investing may be able to understand a little bit more about us. So as you can see throughout all these slides, anytime you see a blue underline, that's a hyperlink. Please make sure to get the handouts, and we'll show you that in just a moment. But we are an investment education organization that focuses on long-term fundamental investors. And as I said at the beginning, all of us are from the DC, Maryland, and Virginia area. All of us are volunteers that like to be able to spread our interest and our love of investing. Next slide. And here's that YouTube channel I just talked to you about. You can be able to go to YouTube, search under Digging into BI, and you will find it. We have 142 subscribers. We're trying to get up over 150. We're doing this program for free. The only thing we ask is that in return for it, you go to our YouTube channel, like the video, share the videos, and then subscribe to it. That's how the algorithm works, and that's how we can be able to spread this message to other people. Over on the right-hand side in the blue box, all of the webinars are organized into what YouTube calls chapters, which means you can go straight to the presentation you want to see. There's little markings down at the bottom of each of those webinars that will be able to tell you, or you can look in the description and we'll tell you at what minute mark a particular stock is being discussed. Next slide. So if you're having any trouble, we haven't had this in a while, but I still keep this up in case people do have trouble with troubleshooting. There's a little quick video on how to get through it. Most of the things, it tends to be audio, and the usual case would be as if you're on your computer and you're using the phone, you're using phone or no audio. The other thing is that if you look where that green arrow is going over from the center to the right, there's a place for the handouts. So you have this completed slide deck and then 4 completed SSGs. So make sure to download those. You can share those with people in your club or with people who you're looking to maybe get involved in your club or just for your own knowledge and education. And again, as always, do your own research, but you can take a look at this information and use it for yourself. Next slide, please. So why are we doing this? Well, it's a way for people in the better investing community, and particularly those in Maryland, DC, and Virginia, can have an opportunity to be able to learn how to use the stock selection guide, or sometimes we talk about the PERT report. If you're not a member and you want to learn more about it, up at the top, there's a free 90-day trial that you can use. And the whole idea is that we wanted to be able to get together with people from the 2 chapters, the Maryland and the DC regional chapter, and be able to work jointly on something together. And it's a way to be able to promote our model clubs and also for you to be able to promote your club. And Cheryl will talk about this a little bit later in the Club Connect program. But it's really a way to be part of the Mid-Atlantic Better Investing community. You do not have to be either a member of Better Investing, nor do you have to be from Maryland, DC, and Virginia. I see some people in the audience are not from there. They're clearly welcome, and we're glad to have you. But we're trying to really sort of help build the interest in Maryland, DC, and Virginia, and we'd love to have everyone else with us as well. Next slide, please. So in just over an hour, we're going to do 4 stocks, which is really, really fast. And so we're going to show 2 presentations that come from the BI magazine. One is a stock to study and the other is the undervalued feature. And then we're going to have 2 more that come from somewhere inside the better investing community, hence the term digging into the BI, either the BI website, BI magazine. It can be from personal experience, but we like to be able to get confirmation from something that you found somewhere inside of the resources that you get as a member of better investing. And down at the bottom, you can see many of the different places that you can get ideas. Next slide. So here's how you can find it. If you and you don't even have to be a member of Better Investing to get to this point. It's the home about news releases, and you can be able to see they announce when these stock to studies and undervalued. So usually about a month to 6 weeks in advance. This one was done on March 28th. That's when Paychex and Pfizer were announced. And again, you can check in advance to see it. They already have next month's up there, and Middleby and United Health Group. So again, a way to be able to check. So if you want to be able to discuss them in your club or just do them yourself and be able to work with a study buddy or talk with us during the course of the presentation when we ask for questions, we'll love to have it. Next slide, please. So as a member of Better Investing, and this is for just them, is that you don't want to miss any future announcements. And if you see up in the top where I have the red circle under my account, you can go up there and you can be able to sit there and sign. You have to sign in, and then you'll kind of go over to the left-hand side where I have the green circle. That's the email and product subscription information. If you click on that, you'll get that green box over on the far right. And that's where you can be able to sign up where I have the yellow highlight, the BI weekly newsletter that comes out from headquarters. And then where that arrow is right there, that's a local chapter news. So if you're in the Maryland chapter, you get the local Maryland chapter. If you're in DC or Virginia, you get the DC regional stuff. And before you do that, you have to then go down and hit where that circle is in the lower right, which is Save Changes. Next slide. So here's what the BI Weekly newsletter looks. This is exclusive to members. It's a way to highlight some of the education that's going on all across the country, not just at headquarters, but in several of the other chapters around there. Many of them are free for other folks to be able to take a look at it. And it's a chance to be able to find out what's going on with what we call ticker talk and stock ups. There's usually some really good educational things there. You can see the updates for first cut reports. That's where people across the country do their completed SSG and upload them. Way to get ideas. It comes out at the close of business on Thursday. And if you signed up and you're not getting it, check your spam filter. But that's a great way to be able to get some more information, to get, more value from your Better Investing membership. Next slide. And so here's what you can do is you can connect with us on Facebook. This used to be just the DC chapter, but I guess we're sort of morphing this into something for the 2 chapters because again, we don't put that much content up there, and it's a great opportunity to just sort of work with each other. Again, you don't have to be a member of BI. You can be just kicking the tires, but it's a way to be able to see some of the stuff that's going on inside the community of better investing, not just in Maryland, DC, and Virginia, but across the country. Next slide. So Cheryl, take it away.
Okay, every month on the 3rd Tuesday of the month, we have a book discussion. It's called Money Matters, and it is between 7:30 p.m. and 9 p.m. generally. This next month, we're going to be offered, this month rather, on the 18th of June, we're going to look at a podcast that features John Coates, who is a Harvard Law School professor, and he's also the author of The Problems of 12, When a Few Financial Institutions Control Everything. And it's pretty much talking about the voting power that the top exchange-traded funds will put across. And please listen in, and after Mr. Coates finishes talking, then we can have time for questions. So please join us. It's virtual, online, and you can see down here at the bottom the website to click on. Back to you, Kevin.
Okay. So this is the Maryland chapter page. They have an ongoing portfolio contest that's been going on, and you can be able to see some stuff over at the local events. Last Saturday, they had their, I really like it. It's they have one of their directors look at the top 100 and 200 stocks from the Better Investing magazine in April and do an analysis of some of the stuff that's coming in there. He's been doing it about 8 or 9 years now, Roger, and it's a really good presentation to be able to see, get some ideas and sort of see what's going on in our community. Next slide. Go to you, Ken.
Okay, so I'm a member of the Happy Destiny Investment Club. It was started in 2001. We currently have 7 partners. We meet on the 3rd Friday of each month from 6:30 to 9 o'clock. And if you have any questions about visiting our club, our contact would be diggingintothebi@gmail.com.
Thank you, Ken. And this is the other club that Ken and I are a part of. This is the Montgomery County Model Investment Club. We meet on the 3rd Wednesday of the month. That's a picture of us at a social event that we had with another club, Pinnacle Group. Some of their members have been regular presenters here. It's an online meeting. We start at 7 and end at 9. And we were going to do, let's talk some of the stock ideas that we saw from Bink. But one of our members said, let's do some bite of Bink that was there before. And the stock study is going to be IRAMED Corporation, another medical device company. So if you want any more information, that's how you can find us with that point of contact, POC. Next slide. And to you, Lisa.
Hello. And so it's the Model Investment Club of Northern Virginia, or McNova as we call it. And we have about 14 partners, started in 2008, and we meet on the 2nd Tuesday of the month. So our next meeting will be June 11th at 7 p.m. And there's the link to the website for the meeting and also the phone number. And our education, we're going to do stocks that we heard at Bink that were of interest to us. So there'll be a few stocks we're going to talk about. And our stock study is Air Products and Chemicals, APD. And then if you want to contact us, it's mcnova@dc.betterinvesting.net.
Thank you, Lisa. Cheryl, to you.
All right, there is a new program. It's going to be officially starting in September, but I've seen a couple of emails that kind of talk about it already. There used to be a visit a club, and this is kind of making it more proactive and connecting clubs with potential partners and with BI members with clubs looking for new partners, kind of get those groups together. And that also becomes a little more dynamic with the fact that a lot of clubs are meeting virtually online, much as our two model clubs and the other Happy Destiny that we talked about. So still though, the decision to join a club as well as accept a new partner remains with the club and the potential new partner. So they both have some control over the situation. But please look into that. If you start at the top that says Investment Club tab, and you can open it up and you'll see Club Connect, and that's where you go ahead and click on that and you will be given a form to fill out. Back to you.
Okay, so this is digging into the BI, so we want to be able to show you, you don't have to wait for it to come into the post office. The June and July issue came out in late May. Twice a year, they have a combined issue. This is one of the times they do it. So you can see it on your computer, laptop, tablet, smartphone, and other things. And you don't have to wait for the postman or postwoman to be able to bring it to you. So those are just some different ways to take a look at it and get it sooner. In fact, I haven't gotten my paper magazine so far, so I've had to look at stuff on both the app and on the e-magazine. Next slide. And if you need to know how to be able to sign up for that, is if you go over where the green arrow is over on the left-hand side, it says Better Investing Magazine for Mobile Devices. It's a different sign-in than what you would have for your regular BI membership. But just go there. It's pretty straightforward to walk through it. If you have any troubles, just reach out to headquarters. The red arrow where it has analyst reports and other resources, that's where there's additional information for the 2 featured stocks that they have every month. So that's the stock to study and undervalued feature. So if you're doing one on those and you're trying to find something, go ahead and take a look at that. You may get some additional information that will be able to help you to be able to make a better decision and therefore make you a better investor yourself. Next slide. So here it is. This was I always like to find some article from the magazine that sort of stands out. And here's one that the Repair Shop column this month features actually some Virginia Club. It started in 1995 and they have 5 partners and stuff like that. The In Pursuit of Retirement Investment Club. They meet on the 3rd Friday, so it conflicts with my own club, one of my clubs. But the fact is that they were saying that they were looking for a place to be able to get some new members themselves. And here's a suggestion is that you can sign up again, as Cheryl said, for Club Connect, but also you can be able to do a stock presentation here as part of the digging into the BI. And we have a pretty good crowd in the audience here. And if someone is in your neck of the woods, in this case, they're over in Gainesville. So I forget what county is that in. Is that Fauquier or is that Loudoun? I forget. Um, but anyway, for us Marylanders, this is way out there. But regardless, there may be someone in that neck of the woods that that's interested, and it's a great way to be able to promote your club and take a look at it. So please consider that doing a presentation because they said that they're looking for new members, and this is a great way to be able to do it. Both the Club Connect and this chapter event that we have together. Next slide. The other thing I like to do is I always like to look at the back page of the magazine where they have the investor education column. It's compiled from headquarters, and there's a lot of these events that are free online, and you don't even have to live in, say, San Francisco or Seattle or whatever. You don't have to fly there. You can be able to see everything straight from where you are. In fact, I know we have several people in the audience here that are from several different time zones away from where we are, and we're glad to have you. And this is how the community works. So please look at some of those things to be able to take a look at it and be part of our community. Next slide. Well, enough for all the intros. Here's it now. We want to be able to get to taking a look at it. So we do 2 stocks in the core platform. And the first one up will be Ken Williams on e.l.f. Beauty that he found through the ticker heat map, and then followed up by that Cheryl Patterson's going to talk about Paychex, which is the stock to study this month. So let's bring it over to Ken and take it away.
Okay, next slide. Okay, so I'm Kenneth Williams. I'm a member of the DC chapter. I'm also in 2 investment clubs, MCMC and HDIC. While I was out at Bank, Kevin asked me about presenting this month, and I suggested e.l.f. Beauty. So this is a company I found on the BI ticker heat map. So next slide. I was looking for a medium-sized company to add to my portfolio some time ago, and I came across this one here. Based on the information I saw on the ticker heat map, there is about 303 studies by BI members in the last 90 days. Next slide. So just to kind of give you an overview of the company, it was started in 2004 by Joseph Shama. He was a 23-year-old NYU business student at that time. In 2016, they completed their IPO. The company is currently headquartered in Oakland, California. e.l.f. stands for eyes, lips, and face, and it is also the name of one of their beauty brands. One of the most popular beauty brands, especially among Gen Z and Gen X consumers, ranking as their leading makeup brand of choice. So They've also have been recognized in the best companies to work for in the 23 to 24 issue of U.S. News. Also, a Forbes 2023 best midsize employers, and also one of the greenest companies in the 2024 Newsweek issue. And then finally, they've also been recognized as one of the most successful mid-sized companies for Forbes magazine for 2024. Next slide. So the top 5 brands in the consumer cosmetic industry are these 5 here. So we have Maybelline, L'Oreal, e.l.f, CoverGirl, and Revlon. So the two biggest, or the 2 that have the largest market share, of course, seem to be Maybelline and L'Oreal. But here's what's interesting. Next slide. Of these brands, they're very well established. Many of them are well over 50 years old, whereas e.l.f. is only 20 years old. Next slide. And you look at how the other companies are growing their market share, and it really seems that they've been losing market share. Maybelline, L'Oreal, CoverGirl, and Revlon, where out of the 5 here, it's e.l.f. that seems to be kind of on fire and expanding its market share. Next slide. So in 2018, they were kind of the leading brand in a number of cosmetic categories. And now in 2023, next slide, you can see that it's expanded greatly across a number of categories. So they really seem to appeal to, they seem to do quite well in the, I guess, the quality of the products that they offer in these various categories. Next slide. You can think of them kind of as one of the most productive brands, in that keep in mind, when they started in 2004, they were just selling online. Now they've expanded their product into Target stores, Walmart stores, and Ulta Beauty. So the next slide, please. And then in Europe, you can find their products in super drug chains, as well as the Boots drugstore pharmacy chains. Next slide. So what's kind of driving this growth? Well, it seems to be their digital marketing approach. They understand that their customers are largely your Gen Zers and your Gen Xers. And where do you find them? Oh, well, they're going to often be on these social media applications, and they know quite well how to market to them on these various platforms. So another thing to kind of keep in mind, for these Gen Zers, at least the ones that are living with their parents, they have a lot of disposable income. So they have a lot of money to spend on products that they offer. Next slide. So here's how they've kind of grown over the past 5 years. You can see that their sales have grown about 27%, adjusted EBITDA at 28%, and their adjusted earnings per share is at around 34%. So they're kind of in that explosive growth phase, I would say. Next slide.
5 minutes, Ken. 5 minutes.
Okay. All right. So jumping into the SSG, I chose 19%. So historically, their growth has been about 19.4. According to the growth rates on the in the value line, it's about 22.5. So I went with 19 here. Next slide. And then in terms of the earnings, I kind of stuck with 19, although value line was suggesting 22, 25 and a half. I just went with 19. Next slide. And then they have some very nice management metrics, well above their 5-year average for the pre-tax profit, return on equity. Their debt is slightly above the 5-year average there, but I don't think it's a big deal. Looking at the 31.1% versus 29.9%, it's not a huge difference there. Next slide. Going to the back side of the SSG, I wound up choosing 60 as the high PE, which is just above the bottom end of the range between 55.6 and 78.8. I chose 32.5, which is the 5-year average low PE for the low PE, and that results in a forecasted low price of $73.40. Next slide. When I was talking to Kevin about presenting his stock out at Bank, it was currently priced at that time in the 150s. Since they recently reported their earnings, they have actually closed today at $196.45. So the stock has really moved quite a bit since that time. So the last time I checked my SSG, the upside downside ratio was about 1 to 1. Next slide. So I'm coming up with a overall return of 11.1%, which is within the certainly within the 18-month target price range and just above the 5-year annual total return range. That was in value line. Next slide. So going forward, they intend to continue to focus on their growth initiatives, expanding into more venues, growing internationally, and then, supporting their strategic extensions. So, so they've been growing in the pharmacies that are in Europe, and there are other areas that they can grow into. So there's a lot of opportunity here. Next slide. So in conclusion, this is a medium-sized company that is well managed, focused on with a focused, innovative growth strategy. It is overvalued as it is trading above its 5-year average PE. I certainly have it as a hold. As I mentioned before, it's about a 1-to-1 upside-downside ratio with a 11% return. And I think this is a company that you would definitely want to consider for your watch list and watch for a potential pullback where you might get a more attractive entry price. All right, next slide. And now we have.
Thank you, Ken. Cheryl, to you.
All right, my name is Cheryl Patterson. I belong also to 2 investment clubs. The first one being the Model Investment Club of Northern Virginia. And I'm also in the club with Kevin and Ken, Happy Destiny. I was a little more taken aback when Ken called me, or actually he emailed me and left a message, and we were driving back from Chicago where Bink was being held. So, so that's when I got the word, and I decided to go with Paychex, which is on the NASDAQ. It's the BI stock to study for June 2024. And I also located it on the newest predefined screen called the A list. So you might want to check out that predefined screen. But here's Paychex at a glance. They're a leader in human capital management solutions. They're a market leader for small and medium-sized businesses with a unique combination of HR technology and tech-enabled advisory solutions. They have consistent growth of about 11%, earnings per share adjusted for diluted, and that's been for the last 5 years. They are number one in operating margins in the industry at about 41%. They've been recognized locally as being a big innovator. They have a growing client base of about 740,000 payroll clients and about 2,200,000 outsourcing clients on worksite employees. They improved their retention. Their revenue retention went from 80% in 18 up to almost 90% in fiscal year 23. And they have a comprehensive suite of the human capital management as well as HR solutions. And that's 76% for the management solutions and 24% for the PEO, which is the professional employers and insurance. So again, they're a leader in small and mid-sized business markets and for HR outsourcing, payroll and human capital management software, retirement, and insurance. They're a leader also in large and growing human capital management market. The market size for employees, this is just in the US, 134 million, and small and medium business segments can be anywhere from 1 to 1,000 employees. They have 69 million there, and Paychex has right now about 10 million of those two areas. So there is a lot of room for growth. So what differentiates Paychex is they have a lot of competition. The list is growing all the time. First of all, they have award-winning SaaS, which is software as a service, and it helps businesses and individuals manage their software and streamline their operation. And you can see also they are top in analytic and AI capabilities, which I'll talk about in the next slide. So here's some of the leading technology provider leveraging industries, their partners and their APIs, which is application programming interface, where they share and extract data within and between organizations. And you can see some big names up there. Azure is Microsoft, AWS is Amazon, and they also have Arista, Equifax, Google. So they've got some of the top companies that they are partnering with. Again, here they're showing well positioned to capture the AI opportunity. They have large and growing data sets. They have one of the largest small and medium business data sets in the industry, and there's a competitive advantage right there. They have history and experience of leveraging AI. They've been doing it for years across the entire business, well ahead of the curve, and they're investing for the full potential here. They also have a comprehensive suite of leading human capital management solutions, integrated technology with recruiting, applicant tracking, onboarding, HR services, analytics, retirement, the list goes on. Also, their lifetime value, you can see, has gone up between these three groupings that they're dealing with as well. So you can see consistent revenue and earnings growth here. Total revenue having increased by 8% between 13 and 23, and the adjusted diluted earnings per share is up 11% from that same time period. And as I mentioned before, they've got industry-leading operating margins. So Paychex transformation from technology and HR to going to management solutions, PEO, and insurance. And you can see what portion makes up within those two different categories. That they have 56% in FY23 of the service revenue in the non-payroll solutions, and an increase of 46% for the outsourcing organic growth from 19 to 23. And lastly, they have a very strong cash flow engine and dividend increase. You can see here the attractive metrics for fiscal year 23, especially that return on equity, which I'll show again in the SSG. So here's value line up at the top, and you can see the PE ratio has gone from 25.6 to 27.5. They do have a timeliness of 4, which is the highest, rather the lowest, and it was recently lowered in April, but they have a safety margin of 2, and safety is quality. So their quality ranking is very favorable. They have also the 2027 to 2029 projections, a low of 8% to a high of 15%. CFRA, if you look down around the middle, you'll see SPGMIs, and that's Standard & Poor's quality ranking of an A+, and the institutional ownership of 76% with a 3-year projected earnings per share of 10. Paychex for Morningstar, they have a 3-star, but you look over to economic moat, which again is the bottom middle, it's wide, and also the capital allocation is exemplary, which are 2 of the really top of the economic moats and the capital allocation that you want to see for a company, and very few companies have them. So here,
5 minutes, Cheryl, 5 minutes.
thank you. This is for the core SSG. I looked at historical sales. Paychex is in the black with its other peers coming in below, and the top blue line is the industry average. The numbers are pretty high as a percent change for Paylocity, Holding, and Paycom, but as you can see, even though the numbers are lower for Paychex, they are well above on the graph. Same thing with the historical earnings per share. They are currently at 7%, and you can see they're kind of right in with some of their other peers, but they still come out ahead in those final 3 quarters. For the core SSG on the percent pre-tax profit sales, they have 37.56% for the last 5-year average. And on the return on equity, they have 40.67% for the last 5-year average. And debt to capital, they are still staying well below the industry average. Here is the historical stock price for sales and earnings per share, with sales being the green and earnings being the blue line. You can't get much more up, straight, and parallel than that. And that shows consistency. They only had a slight dip in 20, but managed to come right back up in 2021 for earnings, getting even above that trend line. The historical sales forecast, they are showing at in the 7% range. However, when I did an average of not only ACE, but also Morningstar and other Yahoo, it came out to be about 6.5. That's what I went with, which is going to result in a projected sales of 7,142,000. or 7
2
billion.
minutes, Cheryl, 2 minutes.
Earnings per share forecast, again, averaging it out, came to about 7. The forecasted high price, I went with the high PE of 30, which was in between the average and the average high. Came out with a high price of 193.1. Again, for the low PE, in between the average and average low, I took 23, came out to be a stock price forecast of 105.6 for the low, which I kept as the bottom low. Here is the graph that shows you it's well within the buy range of a upside downside of 5.7 to 1. Here's a comparison that I did looking at against the staffing and equity for Paychex and Korn Ferry, and then putting that up against that average, and then for Paycom and Paylocity, putting it against software. Paychex still had the most count. Conclusion, Paychex is a medium-sized company. It's a leader in human capital management solutions. It's slightly undervalued. The current PE was 25.9, trading just below the 5-year average PE of 27.4. It's a buy at 107.9 to satisfy a 3-to-1 upside downside and 15% total return, with the current price at 118.75. And it could be a worthy candidate for purchase as a medium sales growth company.
Thank you. All right, so now we're going to do 2 stocks in SSG Plus, and getting us started is going to be Lisa. She's going to be our 19th different presenter this year and our 34th unique presenter since we started this 4 years ago. So welcome to the fray, Lisa, and take it away.
Thank you. My name is Lisa Fosslin, and I'm with the DC chapter, and I'm also a member of the McNova Club, and I'm doing Pfizer on the New York Stock Exchange. PFE is their symbol, and they are the undervalued stock for June, July in 2024 for the BI magazine. And the building right there is their first building when they were in 1889. Next slide, please. Okay, and so they're on page 23 of the magazine, and Pfizer has had huge success with the COVID vaccine. It was proven 90% effective against COVID-19, and in December of 2020, they were one of the first to get emergency use authorization in all the developed countries. But something interesting with the easing of the pandemic and the sales of the vaccine and Paxlovid therapy have plummeted, which of course had an effect on their stock. Paxlovid sales were down 93% over a year, and the vaccine fell 70%. And to tell you what it did to their stock price, on March 13th of 2020, the stock was $30.99. In December 23rd of 2021, it was $58.71, which was a high. In the last year, it's dropped 24%, and today it closed at $29.31. So I was kind of interested to know what else does Pfizer have besides just their stock slide. So next slide, please. And so they have their annual sales are close to 50 billion this year, and they spent 8 billion of that on R&D, which we'll get to in a little bit. And right now, prescription drugs and vaccines are the majority of their sales. They have 46% of their sales are US based, 20% in Europe, 13% in the developed world, and the emerging markets are 21%. And this number is increasing. They're currently working on, like, Brazil, India, and China are a priority right now. And they're also working on making sure everyone has access to the vaccine, which has been a criticism of Pfizer in the past few years. Next slide. So here's kind of a brief history. 1849 is when they were started in Brooklyn. And some things to note: in June 22nd of 1942, they went public. April 17th of 1943, they won the Army Navy E Award, which is an Excellence in Production Award because they supplied most of the D-Day Allied forces with the penicillin, which was made by Pfizer. And then something unique for the company, in 1951, they really wanted to focus on international expansion, and not just to put plants places. They really wanted to decide on a strategy. They wanted to get the proper contacts in the countries, learn the language, understand the customs, and hire local employees. And so this helped take them from, in the early 1950s, to 4,300 employees to over 7,000 by 1958. They have plants in Mexico, Italy, and Turkey, and they now have 80,000 employees. And something is you'll notice in the diagram, they are very consistent with rolling out new drugs. Next slide. And here are some of their current potential growth drivers. And some of these have come from some of the companies they've acquired. And so a lot of these are pretty new, and I'm going to say these names wrong. Abruzio, August of 2023. And Nurtec, which is a medicine for migraines, 2021. And the other two were 2023s, or the other three. So these are pretty recent drugs that they have that have all received FDA approval. Next slide. So something that happened in December of 2023, they bought Seagen, which Seagen is a pioneer of ADA antibody drugs. And they currently have 4 of the 12 total FDA approved on the market. And what's unique about this, but the ADCs, is they are designed to kill the cancer cell and not the healthy cells. They have a very specific way of doing this. They're so successful that their contribution to Pfizer is expected to be $10 billion by 2030. And oncology continues to be one of the largest growth drivers in global medicine. And these drugs here are some of the products that Seagen brings to the mix. Padvic is a drug used to treat urethral cancer. Tidvac and Turkius, and I'm not saying those right, are used to treat cervical cancer. So and to tell you how much this brings to Pfizer, in 2022, they had 24 of the approved cancer medicines, and those generated 12.1 billion. And they're expected to bring 10 billion. So that'll be good for Pfizer in the future. Next page, next slide. And this, I just wanted to show you some of the areas that they are focused on. Most of them, the rare disease is, and that's not due to specifically the disease being rare, but that there's smaller populations that are affected by it. So as you can see, they have a lot of areas they're looking at. Next slide. And I wanted to do a quick, give you an example of what the pipeline looks like for Pfizer coming up. So they have, and this is combined, this is of May 1st, so this includes the Seagen product line as well. They have 45 in phase 1. And this will take about 10 years to move from phase 1 to FDA approval. Only 10% will make it past this phase. The next phase is, this takes a few months to a few years, and is the steepest hurdle at 30%, or that 30% will make it to phase 3. And then phase 3 is usually about 3 years. And this is more just kind of focusing on safety and dosing and getting it ready for regulatory approval. And then it'll hit regulatory approval. And so this is a pretty long process to get a drug from beginning to end. And not all of them make it. But they expect, Pfizer expects to have 8 FDA approvals by 2030. So next slide, please. And here I want to kind of take a look at the industry. And this is, I want you to notice on Pfizer, in 2021, they made 81 billion. 2022, they made 100 billion. And that's kind of knocks everybody else out of the park. And that is, for the 100 million, 57 million, or 57 billion of that was COVID. And so that kind of a pretty big shock to the system in 2023 when that product line was not producing as much money. But something that is interesting, if you look at, again, the 81 billion and the 100 million, they had some money to go shopping with. So between November 2021 to October of 2022, they bought 4 companies and spent about 25 billion. And they bought companies with innovative cancer therapies, immunoinflammatory disorders, another company that specializes in migraines, and some autoimmune therapies. So they're building up their portfolio. And this is something that Pfizer is very good at. They do periodic acquisitions to help build their portfolio. And also Value Line has reported, so there's going to be some competition because of course the weight loss drugs are very hot right now. Eli Lilly and Novo Nordisk have the top 2 names right now. And so they're expected to kind of take over as well, kind of with sales. But Pfizer does have something in the pipeline as well with the weight loss drugs, and it'll be different. Their drugs are injection, and I think this one it's kind of a shot. It's a different form than the ones that are on the market right now. But there are some weaknesses in this industry. There's patent losses, generic competition. You know, the business deals are expensive. And so that's kind of some of the cons according to Value Line. Next slide.
5 minutes, Lisa, 5 minutes.
Thank you. And then, and this, I just kind of wanted to show you, just these are the historical earnings. And usually the big dips with Lilly and Pfizer, kind of wanted to point those out. Lilly's was due to an acquisition, and Pfizer's, of course, was due to the lack of COVID money coming in. And next slide. And this is just to show you the pre-tax profit. Once again, everybody is kind of in the same area, and then Pfizer kind of went down in 2023. Next slide. But I did want to show you that there is hope. So Pfizer is starting to come back, and quarter by quarter, they're building up. They're at 15 billion. They just reported earnings May 1st for the first quarter of 2024. So there's promise. And 20% of this revenue is the oncology group, which is the Seagen acquisition coming into fruition. Next slide. And so this is just quick, just to show you their first quarter. Adjusted R&D is going down because of they're implementing a cost-cutting program to cut $4 billion this year. And so that's part of that. But they do have increased expenses in marketing and promotional materials, which if you watch TV, you see those commercials. Next slide. And this is just to kind of give you a summary of what you've seen. With on the debt to capital, it did go up a little bit in 2023, and that's the acquisition of Seagen. And also you can see it went up in 2019. They bought some of their companies as well. But they did do a good job in 2022 of paying down some of the debt. So I just wanted to show that to you real quick. Next slide.
2 minutes, Lisa.
Thank you. And so the earnings are expected to be for this year $2.15 to $2.35. And this has even been revised upward from a previous estimate of $2.05 and $2.25. Next slide. And this is kind of a Value Line where they're kind of giving them a neutral ranking, but they still see value in the company. Next slide. And this is, I did an example with the payout to take out the 2 years where they had high sales to kind of show you it's still, you know, 39% coming out for payout. So not too bad. Next slide. And so in summary, it is a large, slow growth company. And I believe that the COVID was kind of a spike for them. I'm not sure if they're going to get back to 100 million again or 100 billion, but they are a well-managed company, and that they really look at their acquisitions and patent expirations and kind of do strategy around that to make sure that they are always on top of the next generation of drugs. Morningstar has given it like a wide moat because of their patents and their wide distribution network. And it is, I believe it is a candidate to purchase. It's not going to give you a big bang for your buck immediately. It'll be like 2030 is their big year, but I definitely think it's something for you to consider. And that's all.
Thank you very much, Lisa. And now that you've done a presentation, Cheryl will give you the official handshake and the clutch key that we give to everyone who does a presentation. So
I was
get
looking
that at
forward
your
to that.
next meeting.
Thank you.
Anyway, I'm going to finish up here, and I'm going to be looking at Semler Scientific. I'm like Ken and Cheryl. I'm in two clubs. We're all in Happy Destiny, but I'm also in MCMC, the Montgomery County Model Investment Club. This stock is I found through the ticker heat map, and I'm going to show you how I ended up doing an industry study in this area. So let's go to our next slide. So like Ken, in fact, I even took Ken's slide here from the ticker heat map. I just moved it over to where I am. And I was looking for stuff in healthcare, and the more green, the more favorable. It doesn't mean it's a buy, hold, or sell indicator, but what I'll do is I'll hover over it. And as you can see in the pullout, you can see that the sector is healthcare, but the industry is medical devices. And so I said, okay, let me look at medical devices. And those sales and earnings growth rate, that's their 10-year growth rates, which are really, really high. So we know that there was something going on there, and those are not sustainable. But let's go to the next slide, and let's show you how we work through it. So I come on over here to do an industry study. I just come on over here where I have that red box in the center with the healthcare, click on that. And I said, okay, let me just zero in on medical devices, and then let me focus on small and medium companies. If you want to know how to be able to do this, Ken Kavula did a ticker talk in May of last year that sort of walks through it. It's a really easy way to do it that you can do with a pen and paper and not have to store anything online to be able to come up with some really good stock ideas. And so what I did is I found two other companies, actually a total of 5 companies that all look kind of interesting, presented them as stock ideas to MCMC. We voted on them, and this was one of the other ones. I like to look at 2 or 3 stocks in any industry just to get a pretty good feel for it. So that's how we sort of came down to this one. So let's go to the next slide. So here's a quick visual analysis of it. You can see, again, we see the pre-tax profit in the earnings for those early years are negative, but there's enough there in the most recent years to see good straight lines. We can see in the quarterly that the sales were a negative 12%, but the earnings were 23%. If you look down below the analyst consensus estimates, there's dashes there, which means there's no coverage from analyst consensus estimates on this company. And of course, everyone, if you're regular in Better Investing, you'll immediately see the evaluate management trends that look like a stoplight with a yellow, red, and green. The green is excellent. That's debt to capital, and they have less than 0.5% of debt to capital. And that sort of triggers that return on equity is red, but that's because it started from a return on equity that's up in the 80 percentile. And for those of us that follow this methodology, getting something that's just in the high teens is very, very good. And with no debt, it's even better. So even in their last year, 25% was excellent. And that one up on top, the pre-tax profit on sales, that too, 35% profit on sales. That's 35 cents of every dollar is pre-tax profit. Those are excellent numbers. So don't be sort of scared away just because you see those trends there. Next slide. So let's talk a little bit about the medical device industry. It's really a wide and diverse one. And again, all of these that have a blue underline, there's a hyperlink to them. So please download the handout so you'll be able to take a look at it. But the medical devices can include things like surgical gloves, pacemakers, joint replacements, imaging equipment, and so much more. They're regulated by FDA. And generally, these medical devices tend to be slow and consistent growth. They don't seem to be really, really massive ones. There can be some exceptions to those rules. And they're sort of morphing into med tech, and this is one of the companies that does it. And if you want to be able to understand a little bit more about the medical device industry, there's a YouTube video that's about 10 minutes long. It will give you a pretty good idea of it. So if you want to understand more about the industry, there's 3 different stories that you can sort of glance at that aren't really heavy or hard to figure out and should be able to help you figure out this industry a little bit better. Next slide. So here's Semler Scientific. It's small. I mean, 69 million. Some people won't even begin looking at a stock until they get at least 100 million in annual sales. Some people say, okay, I'll start at 50. Whatever it is, this is on the small side. They're in Santa Clara, California, so that's Silicon Valley. Started in Oregon in 2007. What happened was a cardiologist who started this company and when he was 79 years old, and to be able to detect peripheral artery disease, or PAD. It went public in 2014, so when he was 86 years old. The CEO's been around since 2012, has really good insider ownership and stuff. Over on the right-hand side, you can see it has a financial health grade of a B, which puts it in the top 30% of all companies. The manifest numbers are good, but not great. The problem is that just like there's no analyst consensus estimates on this one, there's very little in the way of, there's a value line, a CFRA, and Morningstar, but they're all quantitative ones, so there's no analyst really looking at it. And then if you have Schwab, you get it too. Again, not an analyst looking at it. So basically, you're going to have to figure this out on your own. And that's sort of consistent with something that's this small size. So let's go to the next slide and do some more. So what is peripheral artery disease? Well, if you want to know, that hyperlink up on the top is from Mayo. So we might as well listen to Mayo Clinic on it. But what it is, it's a narrowing of the arteries, and they can lead to stroke and heart attack. It's caused by a buildup of plaque along the walls. Arterial sclerosis is what it's called. It can't be cured. It can be adjusted with lifestyle changes. That means eating better and exercising, usually walking. Or you can take a medication, usually a statin. That you can't really find this out just by looking at it. Your primary will help you out with this, but there are some testing. And the common one that they do is the ankle bracula. I'm sorry, I butchered that. Index. And what it is, that's where they put a cuff on your ankle and that on your forearm, and they can be able to sort of test to see how you're doing. It's not always 100% successful, but it's the best thing they have. But there's a whole range of other tests that they can do that requires very skilled technicians to be able to do. And you usually have to go to a hospital or an outpatient clinic spot to take a look at it. And it can be very costly to be able to do that. So let's go to the next slide. And this is where Semler comes on in, is they're reinventing that PAD testing, is that their main product is Quantum Flow. It was approved initially in 2011 and then got full approval in 2015. It's cheaper to administer than the ankle bracula, I know I butchered that again, index test, but it has a higher success. It's cheaper to do. It has a higher success rate. It's done in 5 minutes. It can be done with a physician assistance, and it helps save insurance company money because they're able to identify these medical threats sooner. There's about 230 million people worldwide that are affected by this, 8.5 in the US, and the market for PAD devices is about 4.6 billion. Now remember, this is basically a $70 million company. Now it doesn't mean everything's going to go to them, but because again, there are big players in this like Abbott and Becton Dickinson and a whole host of others, but they do have a role that they can be able to get into it. But you can see those 3 quick steps that they have in the lower right-hand corner that you can be able to do this. Next slide.
5 minutes, Kevin, 5 minutes.
Thank you. So Semler Scientific, and I took this from EdgePoint Capital, is that what happens is if you have PAD, you have a 20% of greater chance of getting a cardiovascular death, heart attack, stroke, or hospitalization in the next 12 months. So you have a 4 times likely opportunity to die and 3 times likely to have a stroke. So this is a big red flag if you have a peripheral artery disease. And so what you need to do is you need to get this treated and get the outcome going through. What Semler does is they don't market to doctors like a lot of other people do. What they do is they market to the insurance companies. And the reason they do that, as you can see in the blue box down below, is the only person who loves to save money on healthcare costs more than you are the insurance companies. So QuantaFlow or Semler takes QuantaFlow and says, look, we can save you money and get a better result for you if you end up sitting there and encouraging your doctors to use this kind of test. So that's what they do. And they end up then go to the doctors, and they do just like Cheryl had a subscription as a service. It's the same they have here, but they do offer pay as you go. But it's a great way. So they don't have a sales force. They're a very lean company. They have like about 920 employees in the entire company. So it's a great way to sort of move forward. Next slide. So here's some competitors. And again, a lot of these competitors are not really in the same area. Semler listed in the upper right hand about 6 or 7 that are competitors. And I went through and I even used some of them as examples, and they really weren't good ones. So you just sort of have to realize it. But inside the same size and devices, it's not a bad way to sort of take a look at it. And again, I don't really have much to go on. There are some you can see from Manifest, which is the blue box in the left-hand side. In the center that dominates the peer group comparison in black, that comes from the CFRA report. So as you can see, you sort of have to fumble around with this to get good competitors. And I'll show you what I did on the next slide. So what I did is I took 3 companies here, and you can see where they are: CYXI, AXGN, and EPAD. They're not all in the same PAD testing, but they're good examples because of the similar size. And if you look at this, Semler's in the black. That red line is a break-even point, and only 2 of them are really making money, to keep in mind. And again, they're really blowing the socks off of everyone else in terms of pre-tax profit margin. Next slide. Return
2
on
minutes,
equity.
Kevin. 2
Thank
minutes.
you. Return on equity is a really good number 2. Again, they're much higher than anyone else. And it's a little hard to see on the graph, but you can see it in the numbers that this thing just sort of blows people away. Next slide. The final one here, debt to capital, has the lowest debt by far. And again, it's a little hard to see because those numbers in the graph all get compressed because of some really outrageous numbers from Zynex. Next slide. So when I looked at this, I ended up using just the most recent 5 years, and you can see where those numbers are. And I ended up going with 10 and 10.2. I just was with preferred procedure. I could have forecasted a little bit higher numbers because of some of the opportunities they have for growth, higher than what their historic numbers have been, or at least over the last 5 years. But what happens is it would lead my conclusion to be almost too good to be true. Next slide. So the historic data, you can see we have 10 years of PEs. Again, the early years when it went public in 2014, it wasn't making money. But this current PE, that yellow highlight, is 10.5, significantly below the 5-year average. And even on the lower side, when you look at the current trailing 12 month, which I've highlighted in pink. So again, very much on sale. We have to be careful that sometimes it could be too good to be true. Next slide. So what I did is I forecasted a high PE of 18, a low PE of 6.5. That gave me a high price of 81, a low price of 18. It gives me an upside downside ratio of 4.7 and stuff. I really wanted to keep from, if I were to use some more reasonable high numbers, this thing would get really almost to be too good to be true. Next slide. So
1
here's the
minute,
zoning.
Kevin. 1 minute.
Thank you. The next slide, this is the upside downside ratio of 4.7 to 1. So we're getting a buy and a 4.7 to 1. And let's go to one more slide. My 5-year potential is, again, it's showing that it can be somewhere between a total return of 22.7 to maybe a 13.6 if I use the projected average return. And this is a buy up to 34. I closed it Friday at 29.34, and it went down another couple dollars to take a look at. Let's go to our next slide. So here's some of the threats and opportunities. I won't read them all to you, but the one that I want to point out is a hyperlink on Bitcoin strategy. What happened was last week, Semler said that they're going to take $40 million of their cash and put into Bitcoin. And they felt that that was going to be a more stable environment, that they could also get some appreciation from it than if they were to just keep it as regular cash. So they still have another 25 million in actual cash, but they put 40 million into this Bitcoin strategy. And again, their overall average sales are around $70 million a year. So you may or may not like that, but keep that in mind. Next slide. So I think it's a good, even though it's a small company, I still think it's a steady growth. well managed. It's an odd strategy, this Bitcoin. It's severely undervalued to the point where I have to be a little careful that it may be too good to be true. I have it as, like I said, a buy up to $34, $35. I think it's a candidate to be purchased, but if you want to wait until it has a little bit more legs under its feet and it has maybe $100 million in annual sales, that wouldn't be a bad play either. See how it sort of shakes out. But I think there's a lot to like about this company. Next slide. So we went through all these relatively quickly. Kent was keeping us on the straight and narrow here. So now what we'd like to do is we'd like to have all of our presenters sort of ask you where it fits on sort of the life cycle. And let's go to the next slide. And Ken, I'll start with you. Why did you pick that location, e.l.f., or to put on the continuum there?
Okay, so e.l.f. is growing at a 19% growth rate, or historically even faster than that. But yeah, it seems to be eating the lunch of its top 5 competitors. So yeah, I think it's kind of an explosive growth area.
Okay. Cheryl, you want to tell us why you picked that location for Paychex?
Yeah, Paychex has been around for a while, since 1971, but they are really doing well in terms of taking over the market share from their ever-growing list of competitors, and also having their operating costs low. So I think they're in the mature growth, but they're not. I don't think they're to be counted out yet.
Okay. Lisa, why'd you pick that location for Pfizer?
Well, figured after their growth with COVID, they still have a lot in the pipeline, and I feel that they're kind of just going to be growing at a normal pace now, and so I feel they're in the mature growth.
Okay. And, you know, Lisa was talking about how they Pfizer had 100 billion in revenue one year. Semler has 69 million just for their annual sales. And even though it's a really relatively small company, so it's there really in the growth phase, the fact is that these device industries, it really is not expected to have large, humongous growth, but there's great opportunities going forward there. And if this becomes more the form that people want to be able to use to look for peripheral artery disease, and again, there are bigger players in this market than them, that this is a good opportunity to be in there. So you got a young, small company that has some good growth characteristics. It's really well managed. Next slide. So we've been doing all of this, and we're not asking you which one you think ought to be the buy, but which one has intrigued you enough that you want to do additional research. And Cheryl, why don't you release the poll and let people make their decisions? And while we're doing that, Kent, why don't you check to see if we have any? I just look like there's just one question.
Yes, that's true. And the question is for Ken. I believe, Doug, you can keep me honest on this. This is from Doug's word. So Doug was asking, with respect to e.l.f., the high PE ratios are usually coming or seem to result in lower returns. And I guess that he was questioning why, or how do you rationalize, how does a company rationalize the high PEs that you're using as an analyst? My guess.
Yeah,
Doug,
no,
you can correct me if I'm wrong.
I read it the same way because it came right after Ken's presentation. So Ken, how do you work a high PE for e.l.f.?
Yeah, I tried to stay at the low end of the range, but yeah, when you look at the PE history, the overall the PEs have been rather high. I just try to stay at the low end of that range.
Okay. Very good. It looks like our vote is sort of stopped. We only had 68% of you voting. We were hoping maybe a few more of you would go there. But Cheryl, go ahead and close up the poll and share the results with everyone. Look at that, a dead heat between e.l.f. and Paychex. They just didn't like us, Lisa. We just didn't do enough to impress them.
I'll have to try harder next time.
I know. All right, now that we had that one question, if anyone wants to ask any follow-ups from the audience, you can just raise your hand and can alert us to which ones we need to unmute. Oh, there we go. Alfred has one. All right, I've you're self-muted on your side, Alfred. Go ahead and click on your. There you go.
Thanks. Just my question is for Paychex. Cheryl, who do you think would be Paychex' biggest competitor that's publicly traded not right now? Would you say Paycom Software, because they're kind of a new player? They don't have revenues as big as Paychex, but their growth, their quarterly growth is phenomenal. That's who I would think would be their biggest competitor, but who do you think would be Paychex' biggest competitor right now?
Both Paycom and the PYTF, I think was the other one. If you go back to, and maybe I can do that real quick. Don't remember exactly what number the slide was, but where it was showing the different levels of amounts. So because their revenue and all that was much smaller, let's see, there we go. You can see here, Paylocity, they were negative, and then now they're smaller amount.
Cheryl, we still see the poll. You're gonna have to take the poll down so we can see whether your slide.
Oh, sorry about that. There we go. Because Paylocity and Paycom, which are the two middle rows here, are starting out with much smaller amounts than what Paychex has. They're a little more nimble, and so they're able to, generate these higher growth rate numbers, but not really be much ahead in terms of the historical earnings per share, and also in the sales as well, the same kind of situation that you see. It's much harder for a company that has higher numbers to double and triple and so forth. But the ones with smaller numbers, they can generally do that a lot easier. And so they're all really companies to watch and see what's happening. But the thing I like most about Paychex is that they've been doing AI for so much longer, and they've really got it down right.
Thank you.
Okay. Any other hand? We'll take any other hand raising. I see several people that were here at BINC, and not just all from Maryland, DC, and Virginia. Glad to have you. So if any of you want to chime in, raise your hand. Kind of quiet.
Let me ask a question to you, Kevin, and that is, does insurance pay for the product, I guess, of Semler? That's kind of my question. I mean, do they pay for that product, or is it not paid for? It's paid for out of patients' pockets.
The short answer is I don't know the exact thing. My guess is it's going to be some kind of a copay like it is for most things. But again, what they're trying to do is they're trying to protect themselves. Insurance companies are from the big stuff where you're hospitalized and you have major expenditures that are covered. So for them, it's probably a little bit of like a, ounce of prevention equals a pound of cure. So being able to find this stuff out in advance, and again, this isn't the only method to be able to find peripheral artery disease, but they have shown themselves to do it better than the traditional ABI to do it. So by going through the insurance companies and them saying, look, we're making this eligible, they've obviously made the calculation that it's pretty worthwhile. There was a study that they talked about that Semler did. It was a peer review one. It was called the Nevada study because they were looking at people under Medicare Advantage and how effective this was for being able to track things. Now that doesn't get to the copay, but it did show to the insurance companies how well this is to be able to help save costs. And again, insurance companies want to save healthcare costs as much as you do. So that's the way I would look at it. How much of it is paid, it doesn't know. Again, most of the people that have this are older, so they're going to be under Medicare or under Medicare Advantage, or also have the supplemental with Medicare Advantage too.
All right, thanks.
Any other hands up?
Oh, let's see. Lee. Lee, you have, let's see. Yeah, you can unmute and go ahead and ask your
Yeah, just
question.
unmute it. First, despite the poll, I know I'm biased. I just like to say I thought there were 4 great presentations tonight. I just have a question for Linda on Pfizer. I don't know if you took a look at this, but I'm curious, any concerns about Pfizer being able to support their dividend going forward, given their high payout ratio? Did you happen to take a look at that?
I did. No, because I think that they have a few products that are on the verge of FDA approval, and I really think that that's going to come through. But they're also doing $4 billion in cuts this year, and on the first quarter they had given some numbers, and they've already started cutting. So I really think that the management is looking at ways to streamline the company, because when they came down from COVID, they didn't really understand. I think it just kind of forced them to do some cost cutting. So I'm confident they'll make it.
Okay, thank you.
Cheryl, what we can also do is we can get off the quick poll and we can at least put up the rest of the slides. We can still take more questions or hand raising. Do we see any more hands raised, Kent?
Not yet, so I'm keeping an eye on that.
I'm happy that we're getting some responses. We've gone a couple months without people responding, so thanks for the feedback and conversation. I'm still seeing the quick poll, so I don't know if others are seeing the slides.
Let me hit hide again and see if that. It seems like it's going back through. Uh-oh. Let me go back to my slide here. What are you seeing right now? Just
Yeah, we're still seeing the poll.
Yeah.
Okay. Hide.
There we go.
Okay.
Okay.
Now, if you can share your screen, would be great.
All right. No, that keeps getting back to the.
Want me to become the presenter and take over?
Yeah.
Let's see. I'm going to
Here we go.
get out of the whole thing altogether.
I'm taking over.
Okay, we see the bird.
Yeah. Let's see. So we're here. Can everyone now see my screen?
Yep.
Yeah.
Okay. So yeah, there's a picture of many, but not all of the people that have done presentations for us, and some future ones in there too. That was at BINC. People from the Maryland and DC chapter getting together. Here are the ways to be able to reach us in the Maryland chapter, the DC chapter, and also here digging into BI to be able to take a look at it. But we were glad to have Dennis Gennard from headquarters snap a quick picture of us, although we did miss both Denise Kimberlin and Kent. You were too busy kibitzing with someone across the way. So we'll get to you in 2 years' time. How's that? The next slide here. Next slide. Again, you don't have to be a member of the DC chapter, but if you want to get notices for this, Carol does a great job of keeping everything on, getting everything on out. So you can just join our email list. You can see up at the top here, that's the location. But please join us. We don't inundate you, but that way you can be informed of educational things that are coming on. Kent, to you.
All righty. And as Kevin mentioned at the very beginning, the entire effort of digging into the BI is put on by volunteers, and that is people like you. And so what we would like to ask is if you all have an interest in seeing more presentations, we would love to see a stock that you have presented. Please feel free to volunteer. But in addition, you could also volunteer for your chapter, either the Maryland chapter, the DC chapter, or wherever your chapter might be located. And if you volunteer, you get to learn new skills such as presenting to digging into the BI. You can also present at the BI National Convention, which is a lot of fun. And if you do that, you end up getting some pretty good perks as far as discounted rates to attending the bank, as well as some good subscriptions to the online data feed as well as the BI tools. So keep that in mind as you attend these events.
And while we're
Next
speaking
slide,
of
please.
volunteers and some of the awards, for those that don't know, Cheryl Patterson, she ended up getting one of the big national awards. It's named after Dick Dwyer. He was a member of the DC chapter and one of the early advocates for computerized investing back in the late 1980s. And she won the award. Dick Dwyer's club is still going strong. It meets in DC and it's called the Dwyer Investment Club, named in his honor. So please stay with us and be a part of this. All right, here's the stocks that we have for next month. The stock to study is Middleby Corporation. We also have United Health Group. We just did that last month. We didn't know that it was coming up, but oh well. Palo Alto Networks, and we have one more, a new presenter, someone who we met at Bink and lives in the Richmond area and wants to get involved. So here's a way to be able, and she's just jumping in right away and saying, let me go. So please consider this. It's a great way to promote your club and to also improve your own investing skills. Won't throw you out there. We'll give you someone to train with, to work with, and the like. So here's some of the dashboards that we have up on Manifest. You don't have to be a member of Manifest to see them. On the next slide here are all the links to them to be able to find them. You may not be able to find them if you don't have these links. It's just the way Mark has things over there. But again, you can be able to sort of track these things and see how we've done over time with them. Finally, we will put this up on YouTube. We really appreciate you being here. One last look for questions. Kent, do we have any?
have a hand raised, and Doug, if you want to ask a question, feel free. You are cleared to go. Oh, sorry, Doug. We're
Can't hear you.
not hearing you. So
Any
all right, we'll come
anything
back
else
to you
from
in a
our
minute.
in the meantime, any of our other
Let's see,
presenters want to add something?
Robert is got his hand raised. So Robert, if you want to ask your question, go ahead and unmute and ask your question. Oh, I guess not. All right.
I do want to say something. Please do download the handouts because they do not transfer over when we put it up on YouTube. So you need to I'll leave it up. I'll leave this presentation up a few more minutes so that people can download those handouts. But just wanted to let you know now's the time to do that rather than waiting until it's on YouTube because they do not transfer over.
Rob, I gave you one more shot to see if you want to, your hand is raised if you want to be able to hit your microphone. Try it again. Or you can take your hand down if you don't want, if it was inadvertent.
All right, Robert. Well,
Looks like we lost
I
it.
guess it went down.
Okay. Well, it looks
All
like
right.
we're done here as people are starting to pull away. Again, thank you very much for being here. Please join us next month on Monday, July 1st, just before the 4th, as we dig into the next set of stocks. We look forward to seeing you there and have a great day. Good night,
And
all.
please, organizers, do not end the event for everybody. Just leave for yourself.
Cheryl, I think we can turn it off altogether.
All righty. We'll talk to you again in the near future, Kevin.
Good night.
Good night.